So today mostly we'll be learning about some basic fundamentals that you must use when you are analyzing investments and you're planning to invest money in equity. So the initial portion will be focused on analyzing the industry using Porter FIFO's model, PESTEL model, etc. And then later on, moving on, we'll be doing some financial reporting analysis formulas in which we'll be taking FCFF, FCFE, and doing the valuation. So yeah, hope all the slides are visible and even I am properly audible. So in this session, we'll be discussing industry and competitive analysis, and we'll also be seeing how to do forecasting of companies' revenues, expenses, cash flows, etc. by making some assumptions. So these are the learning outcomes which you can go through. So yeah, I'll give you some basic introduction. So we must be well aware of two terms, which is sector and industry. So sector is a broad term. So it's a broad division of the economy. And in sector, we have multiple industries. So one of the example that I can give you is the finance sector. So the example that I was giving you is the finance sector. In finance sector, we have banking, we have mutual funds, we have insurance, we have capital market. So these are the industries, these are the institutions. Then IT is a sector. In IT, you have software, hardware, semiconductor, etc. And then one of the most popular or the broad sector that mostly we are consumers of is the consumer discretionary sector. So in consumer discretionary sector, we have automobile, we have e-commerce, we have food delivery like Zomato, Swiggy, etc. And then the last example, we have the energy sector, which has oil and gas, we have petroleum, we have refinery, we have consumable fuel, we have energy, etc. Okay. So, besides this, I would also like to give you one information. There is a website called IBEF. Okay, so in this IBEF website, you will be getting all the reports of the industry. So let's say somebody wants to analyze automobile sector or somebody wants to analyze the cement sector. So you must be wanting primary data. So data is already collected and it is already shared. A report has been prepared with the proper infographics and everything. So you can visit this website, IBEF, and take data from there. Then the primary two companies, which I'll be using as an example to whatever theory we are going to see, is Zomato and Swiggy. Now we are consumers of Zomato and Swiggy. Everybody is aware of the business model, how they raise, how they are spending money, how they are earning money, who are the customers, which are the different segments they have. So to start with, Zomato and Swiggy, this comes under the consumer discretionary sector, which I was talking about. And then the industry is that they are the food aggregators and they are also coming under e-commerce, quick delivery, etc. Now you have, whenever you talk about a company, you first have to analyze where are they earning money from and where they are spending. So you must be aware of how Zomato and Swiggy earns their revenue. So the primary revenue comes from restaurant commission. So they are going to deliver the food of a restaurant. Restaurants will pay him some commission. And then we pay the delivery fee. Now they have even started to levy platform fee. So we are going to pay for that as well. And then there are some restaurants that pay advertising to Zomato and Swiggy because they want their shop or store to be seen in the front page. So when you open Zomato or Swiggy, you are able to see some restaurants, popular ones like Burger King, Domino's, etc., and then any local restaurant at your place. So these restaurants pay some advertising fee so that their shop is shown primarily. Then Zomato has got Blinkit and Swiggy has got Instamart. So they are getting money from inventory sales as well. Now this Instamart, this Blinkit, all these comes under dark stores. So they have a kind of warehouse in which they are storing all the inventory. Whenever you place an order, they take the stock from there and they deliver you the goods. So these are some of the different ways how Zomato and Swiggy earn their revenue. Now, cost, you must be aware of the primary cost is paying money to the delivery partner, having building the proper IT infrastructure so that you're able to place orders and everything goes on smoothly. So they have to invest money in tech and infra, and then they also need to invest money in the dark stores, which I was talking about, which is their warehouse. Then you have to analyze the industry in terms of competition. So Zomato and Swiggy, the primary competitor is going to be Zepto. Now even Big Basket, looking at them, has started BB Now, which is instant delivery. Then we have Amazon Fresh, we have Flipkart Minutes, and even Rapido has planned to enter the food delivery segment. So you have to remember this example and whatever theory we are going to study today, you have to. Okay, so what is the primary use of industry analysis? For investors, the most important thing is the share price because you are investing money in a share today, the share price goes up and ultimately you're building wealth. So one more thing that you have to understand, which many of you will be aware of, the share price of a company is determinant of its future expected performance and not its historical performance. So if let's say a company is expected to outshine in the future, then the share price obviously will go up. So the share price is reflective of the future expected performance. In future, let's take the example of Indigo. So they are having a lot of short-term crisis because of which the share price was constantly tanking. Why? Because the short-term, perception of Indigo is slightly negative because of the crisis they are facing, the shortage of flight staff, and the new regulations which have kicked in. So this is what impacts the share price. If we are expecting something negative, the share price will go down. If we're expecting something positive, the share price increases. Now we have many overvalued companies as well. For example, Lenskart, and then now we have Grow. Now I recently read an article that the valuation of Grow is equal to the valuation of this BSE Sensex. So BSE Sensex has been operation since the last many years, but Grow is a new company. But both of them are having same market capitalization, which is slightly shocking. Why? Because such an old company and such a new company having the same kind of valuation. Why? Because Grow is expected to grow in the future. To correctly predict a company's future performance, the analyst must first understand the sector, the industry, the environment in which the company operates, who are the competitors, from where are they earning their revenue from, what are the costs, and if there's a chance that the cost will be impacted by new, let's say, increase in the price of raw material or dollar fluctuations, forex fluctuations, increase in the price of crude oil, increase in interest rates. So there are a lot of factors, external factors, which impact the operations of a company. So the use of industry analysis includes understanding a company's business environment, the growth opportunities, competition, business risks, etc. Now, Zomato and Swiggy, this is a duopoly kind of a market where we have only two major players. Now, if somebody new wants to enter into this particular dynamics, then they will probably have to spend a lot of money, build infrastructure, IT infrastructure, the logistics. They have to do some advertisements. They have to work out on a lot of cost, build the manpower, etc. So it is slightly difficult for a new competitor to come in. But let's say somebody is opening a medical store, a kirane ka dukan, so anybody can do that. So the competition over there is very stiff, ease of entry and exit. So we have to do all this analysis, which we will learn in today's session. Now, identifying active investment opportunities, investors use something known as a top-down approach. Another approach is a bottoms-up approach. So top-down approach, what we do is we first analyze the industry. We before that we analyze the economy. Then we call it an EIC approach. E is analyzing the economy, I is analyzing the industry and the sector, and then C is analyzing that particular company. So let's say there's a foreign investor, he wants to invest in any of the international markets. So first he will check, okay, is country ka economy kaise chal raha hai? How is the political scenario over there? Are they in any kind of wars? And what are the natural resources available in this country? Are they a net importer, exporter? How is the GDP growing, etc. So that is analyzing the economy. Then this industry and sector which we were discussing, they'll find out which are the most attractive investment opportunities. There should be a good future growth potential and also potential to earn profits. Then only we'll make the investments. Next is portfolio performance attribution. Now in portfolio management works in a way that we meet the client, then we decide where they want to invest the money. And then when we make the investment, we have to compare. So let's say the portfolio manager is coming and saying that your portfolio, I have managed it and I have generated a return of 12%. Whether 12% is good or not, how will you come to know? You have to compare it with something. So we need a benchmark. So let's say Nifty 50 has given a return of 20% and manager is coming and saying that I have given you a return of 12%. So we know that manager has not done a good job. So this benchmark and all these performance attribution is also possible when we are doing industry and equity analysis. So these are some of the steps when we are analyzing a company. First, we have to define the industry. Now, all these definitions have already been given. So we have GICS, which is Global Industry Classification Standard. And they have done all the research and they have come up with 11 major sectors under which all the companies and industries fall. Now, it is very subjective because there are many institutions who are doing this research. Someone will say that there are 11 industries. Someone will say that there are 12. Someone can even say that there are only 5 industries. Like we have the service sector, we have the manufacturing sector, and we have the agriculture sector. So, it is very subjective because everybody will have their own classification. Then we have to see what is the size of the industry, what is the growth potential, what is the trend. So if any of you have seen Shark Tank, you might know they will primarily ask you, iski market size kitni hai? So whenever you come up with a new product, so let's say it's a very small market size having like 300 crores, 500 crores. So they don't see this to grow in the future. They probably might not want to invest money. Also, if there is a lot of competition. So analyzing the size of the industry is also important. Then we have two models of analyzing the industry. It is the Porter Five Force model and the PESTEL model. So PESTEL model is political, economic, social, technological, legal, and environmental. So you'll be learning this in this session. And then we do a competitive analysis. For example, we will analyze Zomato, we'll analyze Swiggy, and find out which one of them is better for an investment purpose. So primarily the industry classification in India, it is done by CMI, which is Center for Monitoring the Indian Economy. Then we have GISC, we have Russell's, we have ICB, and we have TRBC. So these are some of the institutions which have done the research and they have identified sectors, industries, and they have also given us sub classifications. So yeah, these are the 11 major sectors which they have identified. So I'll give you some examples over here. So in consumer discretionary, as we have discussed, we have Zomato, Swiggy, we have automobile, we have hotel, we have e-commerce, and then utilities, we have electricity, gas, water, etc., whichever is useful for us. Now even telecom is included over here. Then in consumer staples, we have food and beverage. Real estate is obvious, healthcare, energy is also obvious. Financials I've given you in the start. We have banking, insurance, mutual funds, capital markets. In basic material, we have chemicals, cement, construction materials, technology is obvious again. Then in industrials, we have defense, we have aerospace, we have logistics. And in communications, we have telecom, social media, entertainment, Netflix, Amazon Prime, etc. Now, here are some limitations in this classification system. So first limitation is inappropriate grouping means either it is excessively broad or narrow. For example, consumer discretionary. Now, consumer discretionary is very broad. You also have, Zomato and Swiggy, then you have automobiles, and then you have hotel, e-commerce. So these are varied businesses. And grouping everything under consumer discretionary is somewhat vague. So some may consider that sab kuch consumer discretionary mein aa raha hai, even though the industries are not related to each other. Now, finance, on the other hand, we have banking, insurance, we have, let's say, capital markets. So yeah, there is some sense, okay, these three things are related in one way or the other, but relating hotels, relating automobiles with food delivery is somewhat vague. And then there are challenges in categorizing companies selling multiple products. For a best example is Reliance. Now, Reliance ke itne sare business hai, it is very difficult to say Reliance kaun se industry mein aayega. Now, okay, major it is petrol, oil, refining and everything, but now they have expanded. It's basically a conglomerate. That means operating under different segments. So it's very difficult to categorize Reliance in a particular industry or a sector. Now, not all services are universally offered. So, depending on the country, now let's say in US. In US, logistics can be considered as a very developed kind of an industry, very stable kind of an industry, but not in India because recently a lot of companies like any delivery companies, you can take the example, they have getting listed and they have started operating. So, it may be varying depending on the country. Some may consider a particular sector or a segment to be matured. Some may consider it to be a growing sector. So delivery is an example of investing of logistics. Now, some classifications may have been outdated. The best example is AI. Now, AI तो सब चीज में लग रही है. मतलब बैंकिंग में AI है, खाने में AI है, ठीक है, एंटरटेनमेंट में AI है. So if a particular company is coming under AI, it is very difficult to classify कि किसमें आएगा because literally AI is into everything. So some classifications have become outdated and it is very difficult to categorize company into a particular sector. So there are some basic key matrices which they use. So first is geography. We can categorize by geographical regions. So markets, we have developed markets like US, Europe. We have developing markets like India, China, etc. Then business cycle sensitivity. This is very closely related to economics. So we have a business cycle in which, it's a starting, it's a very boom, it's a growing kind of a thing. Then we reach a peak in which, things have stopped growing. Then we have a downfall, we have a recession, and then we have a trough where things stop falling, and then there's a potential to revive again. Now, there are some companies, sectors, industries, which are either defensive or cyclical. डिफेंसिव बेसिकली मीन्स कुछ भी हो जाए तुम इसके प्रोडक्ट्स कंज्यूम करना नहीं छोड़ोगे. फॉर एग्जांपल इलेक्ट्रिसिटी, वाटर, गैस, इंटरनेट, entertainment, etc. Cyclical is depending on the business cycle. So let's say when there is a recession, people don't have jobs. Okay, they are very wary or very careful where they spend money. So nobody will go and buy a new automobile during that time. So it is cyclical. That means it totally depends on the economic cycle. If economy is doing well, this sector will boom. Otherwise, this sector will not experience much of a demand. Then we have financial metrics. We have like market capitalization. I gave you the example of grow. So market capitalization is basically how many shares are there, total number of shares multiplied by the current market price. So we are able to calculate market capitalization. Then valuation is what we will learn. Profitability is, if you are commerce students, you would have learned about net profit, gross profit, operating profit, etc. Now, ESG investment is newly into trend. So we will invest in companies only if they are responsible towards the environment, towards the social life, towards the society, and then they have some kind of governance. That means what is the attitude of the management? Is the management very careful about where they are investing money? Are they, consumer friendly, employee friendly, etc., and environment friendly as well? Then talking about the industry size, the industry size is total annual sales of the product, which is not always same as the total annual sales of all the company in the industry. Now, the best example I've given you is Reliance. So Reliance का petroleum में जो total उनकी sales है, that will be included in the sales of industry. जो telecom में है, that will be Jio. जो telecom है, that will be included in the telecom. और उनकी जो Reliance Fresh वो है, that will be included in, let's say, food and beverages. And then unki jo Reliance Retail hai, which is, let's say they are selling electronics and stuff, that will be again included in consumer discretionary. So industry size basically talks about is product ka particular total sales of all the companies, whoever is engaged into the business of manufacturing or servicing, unka total is product ka kitna hai. Then we calculate the industry growth using arithmetic or geometric mean methods. These methods are there in quants and it is also there in portfolio management. So arithmetic method is simple, mean or average. Geometric one best example is CAGR. Then growth industries retain significant growth potentials while mature companies do not. So I'll give you examples. Hindustan Unilever, it's a company which is matured. It pays periodic dividends. Any company that pays periodic dividends, उसका मतलब ये है कि इसके पास grow होने की capacity काफी कम है. So because they don't need money to grow, they are distributing money to the shareholders. So any company that is giving a lot of dividend, the first thing you may want to analyze is it a matured company? So Reliance, Britannia, TCS, even though TCS is slightly growing, but then still it pays periodic dividends. And companies that do not pay dividends usually want to retain money because they want to invest in research and development. They want to invest in new products. They want to enter new markets. So that is why they want to grow and they don't generally pay dividend. So dividend paying companies means potential to growth is very less. Not paying dividends means maybe they want to grow. Then we also need to check business cycle sensitivity, whether economy is booming, is it under recession, is it growing, or is it very stable or stagnant, etc. We have to do that analysis. Then we have something called as a style box that will help you analyze whether it's a growing company and which business cycle it is falling under. So here's an example. Now this style box, the first thing which I would like to talk about is different countries may ye style box can operate in a very different way. So let's take the example यहाँ पे. So consider freight. So freight or logistics is particular country mein it is coming under cyclical and it is coming under mature. So that means it's relatively very stable, but it is subject to the economic cycles as well. Then pharmaceutical is defensive because कुछ भी हो जाए तुम्हें pharmaceutical के products खरीदने ही पड़ते हैं. Whether you are having whether you have a lot of money, you don't have a lot of money. Medicines are basic requirements. So any basic requirements comes under defensive and it is matured. Gaming is relatively growing and it is again defensive because depending on what is the population attribution. So we have a lot of young people, then they will obviously be interested in gaming. Then we have semiconductor, we have digital advertising. So we are classifying different sectors and industries as defensive mature, defensive growth, cyclical mature and cyclical growth. So over here, we are testing the sensitivity to business cycle driven by whether the product is discretionary, capital versus recurring and the interest rate exposure. And then we also check whether it is having a high growth rate or whether it is having a low growth rate. So just to make a note, style box is something which talks about, what is the growth rate of that particular industry and under what business cycle it is coming under, whether it is impacted by the business cycle or it is very defensive against the business cycle. Any questions so far? Are you able to follow whatever we are discussing? Anyone would like to post anything in the Q&A? Okay. So now moving on, we'll talk about industry profitability and market share. Now, industry profitability, you have to identify, as I was talking about, we have something called as the EIC approach. So E is the economy, I is the industry, C is the company. So after analyzing which the particular economy or the country in which you want to invest your money, whether the economy is growing, whether the GDP is growing, what about the inflation, what about the interest rates, what about the political scenario. After analyzing all that, when you move to the industry, you have to check whether the industry is profitable or not. Now, in India, the FMCG business is very profitable. The broking business is profitable because, best example is Zerodha. Okay. If we talk about the least profitable businesses in India, the first one comes to mind is airline industry, because airline industry, except for Indigo, none of the airlines are making profits. They usually struggle to make profits. There are a lot of regulations, and then we see operational mishaps as well. So we have to analyze the profitability of the industry. So industry employs ROIC, which is return of invested capital. So return of invested capital talks about what is the return the company is generating for debt holders as well as for equity holders. Then we have to identify clear trends over time. Again, that will be helpful to analyze what stage of business cycle it is in, whether it is growing or whether it has reached a peak or it is under fall. Then talking about market share. This helps us to understand whether the particular industry is very concentrated or very fragmented. Now, these two terms are very important. Concentrated means it is very concentrated means there are very few companies in this industry. Lot of players means it is fragmented. So concentrated versus fragmented. I'll write it over here. We have concentrated. That means low competition. Then we have fragmented. We have high competition. Concentrated example is duopoly. And this is like a very competitive market. If we talk about Zomato and Swiggy, it obviously comes under the concentrated because it's kind of a duopoly because we only have two major players. So whenever we have less number of players and we have very less competition, we say that the industry is concentrated. And when we have a lot of players in the market, we say that it is fragmented. So one of the measures to identify whether it is a concentrated or a fairly competitive market is the HHI, which is the Herfindahl-Hirschman index. So after taking the score of the HHI, we are able to determine whether it's a competitive industry or a non-competitive industry. So if the HHI is less than 1500, that means it is low concentration. So less than 1500 means competitive. So if we have less than 1500, we say it is competitive. If it is between 1500 and 2500, it is moderately concentrated. And if the HHI is greater than 2500, we say that it is highly concentrated. So if it is greater than 2500, very few firms are operating in this industry. Okay. So in India, this analysis is done by the CCI, which is Competition Commission of India. So whenever companies are planning to merge or one company is planning to acquire another company, they check this Hirschman-Herfindahl index and see to it that the industry remains competitive. Otherwise, what will happen is if there are only two players in the market. Now, if you think about it, we have Airtel and Jio, not including Vodafone and Idea over here. So Airtel and Jio. If both these players come together and then they decide that per month we are going to charge per prepaid customer 500 rupees, for the prepaid plan. So the cost will go up. If these two players join hands, then it will be very difficult for the consumers. So that is a risk which we want to avoid. On the other hand, as long as they are entering into price wars, okay, they will reduce the price, the other person will also reduce the price. It is okay for us. But the moment they both decide that we want to increase the prices, it becomes very difficult or it becomes very wrong from the consumer perspective. Moving on. So we'll see an example. So over here we have 5 firms. How to calculate this HHI is the next task. We have 5 firms and we have their market share. So one of the firm is having 35%. This is probably the market leader. Then we have 25%, 20, 15%, and 5%. We have to first find out whether it's highly concentrated or whether it is relatively competitive. So what we do is we take the market share and then we square it. So we have 35 squared. we will add 25 squared, we will add 20 squared, 15 squared, and 5 squared. If we do a total of this, it comes to around 2,500. 2,500 means we have less number of players in the market and this is less competitive. And then, it is very difficult either to enter into this particular business and, a lot of setup costs are involved, regulations are involved, etc. Now, what is going to happen is these two firms have decided to merge. They have decided to become one. So now what will happen is they have a market share of 20%. So this will now become 20 squared. Now, if we take a total of this, it is coming as 2656. So now we have only four firms and they are controlling majority of the market. So less number of firms controlling majority of the market. We say that industry is very concentrated. For your understanding or simplicity of remembrance, you can take Zomato and Swiggy. Let's say they cover almost 90% of the market because we have small players like Zepto and everything. So over here, we have less number of players and this is highly concentrated and HHI will be very high. You can just write these notes, these points. Zomato and Swiggy 90% market share. It's very highly concentrated, less number of players and the HHI is very high. And then just using these 3 points, you're able to cover or you're able to make notes for your exam. So Zomato and Swiggy, let's say they control 90% of the market. It's highly concentrated and the HHI is very high. So you can easily remember, अगर HHI high है, मतलब competitors ज़्यादा नहीं है, less number of players है, and then the scope of new people entering the market is very less because of a lot of reasons that we'll see next. So as we were discussing, we have two tools to evaluate the particular industry. So first is the Porter 5-Force model. So in Porter 5-Force model, if we analyze 5 factors in the market, we are able to determine, whether this is a competitive industry, how is the profitability, what is the threat of new players coming in, whatever products they are offering, do they have substitutes or this is the only product which is available? Because let's say if it is the only product available, you can charge a premium. Apple is the best example. It is the only product, so that is why they are able to charge premium. On the other hand, Android has a lot of players manufacturing the handsets, so they are relatively more competitive. So strategic analysis is understanding the competitive environment within the industry. It helps us to understand whether the industry is attractive or not. Plus, it helps us to understand the positioning of the firm in the industry. Are you the market leader? Like Reliance is the market leader. It can set the prices or it can take decisions without compromising its market share. Within an industry, the company's market share is indicative of a relative competitiveness. So let's say there are 100 players in the market. Each of them is having only 1% market share. Very competitive. Very competitive, low HHI. In general, greater the sustainable competitive advantage of the company, greater its value. An example I would like to give you is CAMS, Computer Age Management System. It is a share which is listed in the Indian markets. It's a registrar. So basically all the information which is there, it is stored with CAMS. Another best example is IRCTC and we have LIC as well. Okay. So sustainable competitive advantage, agar company ka zyada hai, to uski value zyada. So if you are the major player, if you are the only player in the market, you have something called as a moat, MOAT, terming Warren Buffett. That means competitive advantage is very high. This analysis focused more on the industry structure and its long-term profitability rather than looking at the competitive position of the firm vis-a-vis its competitors. So this only talks about the industry structure. If a particular company is very profitable, so let's say LIC is having the largest market share in India, which is around 60%. If LIC is very profitable, this analysis will only tell you that LIC is profitable. But वो profitable क्यों है, वो ये analysis नहीं बताती. So this analysis does not help you to understand why a company is profitable. It will only tell you that it is profitable in nature. So what are the 5 forces that you must be aware of? First is intensity of rivalry. That means how is the competition? Are firms constantly engaged in kind of price wars? Are they offering similar kind of products or are they offering very different kind of products? If they're offering different kind of products, then the rivalry is very less. Then can new companies enter into the market and can they offer very similar product? Now thinking about new company entering into the food delivery business, like Rapido is Prime. Uber Eats was there, but Uber Eats went out of business and we only have Zomato and Swiggy. So is it easy or is it difficult to set up new kind of business? Another example is telecom. We only have 3 major players. If somebody else want to step in, they have to incur a lot of capital expenditure. Then threat of substitute products. If a lot of substitute products are there in the market, you can switch from one brand to another. So best example, we can relate it from our daily life. We always check Zomato. Some people check Swiggy. Discount सबसे ज़्यादा कौन देता है? Some restaurants give discount in Zomato. Some restaurants give discount in Swiggy. तो जहाँ पे भी discount हमें ज़्यादा मिल रहा है, what we do is we order from there. So it is very easy for us to switch. So you can switch from one company to the other depending on if you're not very, a brand loyal kind of a person that नहीं मैं Zomato से ही order करूँगा. So you can easily switch between Zomato and Swiggy. So substitute products, you have Swiggy, you have Zomato. There are only couple of substitutes over here. If more substitutes are available in the market, then that means it's a highly competitive industry. Then what is the bargaining power of customers? If customers can easily switch, then the bargaining power is very high. You can write this down. If customers can switch, bargaining power is high. So in CFA, it is very important that you prepare your own notes because you will not have time to read all this content a day before the exam. So it is very easy. If consumers can easily switch between the products, the bargaining power is very high. Again, example, Zomato and Swiggy. I have taken this example on purpose because a lot of you will be able to relate to. Then we have bargaining power of suppliers. If there are less number of suppliers of the specified resource, then they have high bargaining power. The best example is semiconductor chips. Now, if there is a shortage of semiconductor chips, the prices of literally all the equipment manufacturers, all the equipment goes up. So यहाँ पे you can write the example semiconductor chips. Okay, so using these points, we are able to analyze this particular industry. इनकी future growth कितनी है, और profit potential कितना है, कितने number of players है. Because whenever as an investor, if I want to invest money in any particular stock, I want the company to earn more profits. I want the company to have a good future. Then only the share price will go up, and then only I'll make profits. So this is one of the primary strategic analysis tools that you can use. So if we apply this strategic analysis, the Porter 5 Force model with Zomato and Swiggy, so rivalry among existing competitors. If we talk about this, the rivalry among both these competitors is very high. Both of them engage in something known as a price wars. Now earlier 199 rupees you have to have the minimum order value so that they will deliver. Now they have reduced it to 99, and then membership fees have also gone down. Okay, earlier Zomato Gold was very expensive. Now you're able to buy Zomato Gold in like 30, 40 rupees or even 100 rupees. Sometimes you get coupons in which they give you free Zomato subscription for 3 months. So rivalry is very high. Then bargaining power of buyers, that means the consumers, that is also very high because as I've said, you can switch between Zomato and Swiggy. Then bargaining power of suppliers. For restaurants, the bargaining power is medium to high. Let's say it depends on the popularity. Or, a restaurant which is there, it has got a lot of footfall. People go there to eat, so they have high bargaining power. They will tell to Zomato and Swiggy, मैं commission से 15% दूंगा. Why? Because even if I'm not there on Zomato and Swiggy, my business is still going strong. On the other hand, if you are a newly opened up restaurant, you will obviously want Zomato and Swiggy to increase your exposure. So over there, we can say that the bargaining power of suppliers is medium to high. It is very low if you are a new player in the industry. Threat of new entrants is low over here because it is requiring a lot of investments in logistics, in tech, and you need to burn cash as well in order to capture the market. So these companies, why are they lost making initially? Because they have burnt a lot of cash in order to capture the market. Threat of new substitute is medium to high because again, as I've said, you can switch between Zomato and Swiggy. Strong forces means low industry profitability, and analysts can be alert to drivers of future industry profitability. So as I said, if the competition is very high, the profitability is impacted. We want the competition to be low so that companies have some kind of pricing power and they are able to generate high revenues and high profits. Okay, if you have any questions, you can post it in the Q&A. I'll frequently visiting the tab to check if there are any questions. You can even unmute and ask if required. Now, how does different factors impact the pricing power? Now, as I've said, let's take the example of Airtel and Jio. Now, ease of entry. Can a new player easily establish their own, service, mobile service? The answer is no. So that means ease of entry is not there. Ease of entry, always think, is it easy? Can I go and set up this kind of a business? If the answer is yes, the ease of entry is very high. If it is very difficult, it requires a lot of money, a lot of technological investments, a lot of cash burn, then the ease of entry is not high. An industry can sustain high profitability only if there are high barriers to entry. High profitability is possible when there are high barriers to entry. If people can easily enter and start this business, then that means तुम्हारा जो भी profits है, somebody else is going to eat that. So if it is very easy to start this business, it is very difficult to capture economic profits. The new competitors can easily enter and the economic profits will go down and your profitability is impacted. Industries such as e-commerce or internet-based business typically have low entry barriers due to limited capital requirements and easy access to technology. The best example is Meesho. Now, if people have not used Meesho, you will surprisingly find that the products are very cheaper compared to Amazon and Flipkart. The only downside is if you are ready to wait, you will get the product at a cheaper price because they don't have instant one-day delivery as like Amazon. So best example is Meesho, Amazon, and Flipkart. There are low barriers to entry because we have many players in this particular segment. So the pricing power is very weak. E-commerce sellers, anybody can start selling via Amazon or Shopify, leading to intense price competition. Food delivery cloud kitchens again are an example. Anybody can start from their home. They can start delivering healthy food. So over here, the profits depends on how good your food is. So if it's a very tasty food, then you can charge a premium and your profits will also be high. However, the reverse is also not true. High barriers to entry do not necessarily guarantee high profitability. Best example is airlines. So it's not easy to start an airline business and the profitability of airlines is very less, especially when the competition within the industry is intense. High barriers, but still weak pricing power, telecom. As I've said, if both companies decide to collaborate, they can increase the price, but more than collaborating, they are really bent on fighting each other and they are engaging in price wars. Petroleum refining, it is highly capital intensive, but prices are influenced by global crude prices and regulations. So in India, taxes are imposed even if global crude prices fall. Our petrol and diesel doesn't get cheaper because most of the profit is taken away by the government. So these are some of the examples. The barriers to entry are high, but still these companies have weak pricing power. The next is industry concentration. So if, as we have discussed, if it is high concentration, then that means it's a duopoly or an oligopoly kind of a market. So there are very few players in the market. And if there is fragmentation, that means there are more players in the market. So concentration refers to the degree to which market share is dominated by a small number of firms. Highly concentrated industries like oligopoly, monopoly, duopoly, etc. They exhibit stronger pricing power as fewer competitors reduce the incentive to engage in price wars. So again, if Zomato and Swiggy combine and they want to charge you like $9.99 for an annual membership, then it will be really good for the business because their revenues will go up, but they will not do it and they will always engage in price wars. Firms in such industries may exercise implicit coordination, allowing the prices to remain stable or increase without significant loss of market share. So if they collaborate, they can increase the revenue and not lose their market share as well. In contrast, fragmented or highly competitive industries with many small players tend to have weak pricing power because you are bidding with another company. If they are reducing the prices, we will also have to reduce the prices. The best recent example I can give you is Bisleri because Campa Cola has come up with a refined packaged water. They are selling it at 15 rupees per liter. So Bisleri, Aquafina, they also had to cut down their cost. They are selling it at 80. Now, if Campa Cola decides to bring it down even to 10, Campa Cola belongs to Reliance brand. So if they decide to sell you 1 liter of refined mineral water at a price of 10, then it will be very difficult for Bisleri and Aquafina because they may not be able to reduce the price as much as Reliance. So Jio was another example. If you remember when Jio came into the market, it was offering you 3 months or 6 months of free service. You can just get a SIM card, you can get free data plans. So that is how they were able to capture the market by burning some amount of money. Some examples, high concentration, strong pricing power. We only have Boeing and Airbus who are into the airline manufacturing segment. So they are the OEM manufacturers. Then we have credit card networks. We only have Visa and MasterCard globally. We have Amex, but not that much of market share. RuPay is there only in India. Low concentration means weak pricing power. Example is India apparel retail. There are thousands of brands selling shirts, jeans, and any clothing. So retailers have to compete largely on the price. And then there are also local construction contractors. Because the competition is very high, they have minimum pricing power. So over here, you can make a note, high competition, low pricing power. Low pricing power means profitability is limited. On the other hand, if competition is low, you can have high economic profits. So economic profits will be covered in economics, but it's supernormal profits, which you can earn over and above your cost, which you are in. So moving on, industry capacity. So tight or limited industry capacity gives firms greater pricing power. So industry capacity is talking about supply. Law of economics, limited supply, high prices. So if a product is very limited in availability, people are willing to pay more in order to purchase it. The best example is artifact painting, one of a kind things. So people will always compete with each other and then prices can go up. So tight or limited industry capacity gives firms greater pricing power, whereas excess capacity leads to price undercutting and weaker profitability. So the entire slide is just covered in that point. If the supply is very limited, then the prices can be high. If prices can be high, profitability can be. Limited supply, high prices, and high profitability. From economics, we have learned that capacity is generally fixed in the short run, but it is very flexible in the long run. For example, physical capacity like manufacturing equipment. So it is very difficult to expand quickly. You have a small space. Let's take the example of a cloud kitchen. You're running a cloud kitchen from a very small space of, let's say, 200 square feet. It might be difficult for you to, get a particular new shop. Let's say the adjacent shop is not available. So it might be very difficult for you to expand. So expanding your operations physically might be difficult in the short run. Financial or human capital can be relatively easily reallocated. So let's say you need one more person, you can hire and you might get it tomorrow. You need some money, you can take a loan, or if you have capital, you can invest it from your own pocket. So physical capital is difficult to expand quickly. Financial capital can be, relatively much more flexible than physical capital. So real world examples, semiconductors, we had chip shortages and then the prices went up. So when there is a chip shortage, one thing you have to remember is if you're ordering an EV or if you're ordering any kind of automobile, the waiting period goes up. Why? Because the semiconductors are not available, the car will not be able to complete, and then the delivery is usually late. Luxury hotels peak during tourist season. The best example is Goa. Right now, New Year is coming, so prices will go up. Exorbitant prices, 30,000-40,000 rupees per day. If the capacity is excess, then the company will have weak pricing power. So if the demand goes up, you can increase the supply, match it, and prices will not be that rigid. So prices are flexible and profit earning capacity is also less. Example is steel industry. Global overcapacity leads to price undercutting. Similarly with crude oil, when the supply is very high, we know that the prices are going to go down. Airlines. So airlines basically wants their aircraft to be full. So if a number of passengers flying from one place to other is not that much, then you will see that the prices are relatively cheaper. And let's say Mumbai, Delhi, the prices are relatively cheaper, much more cheaper than Rajdhani sometimes. Why? Because players are competing amongst themselves and it's a widely traveled route. So, there are a lot of options available, timing flexibility, multiple flights. So there are some flights which relatively go underfilled. So that's why the prices are lower so that people opt for the service. So limited capacity, low supply and high pricing power. That was the conclusion. Next, we have market share stability. Stable markets shares indicate established leadership and disciplined competition, allowing firms to maintain or increase prices. So let's say if you are the market leader, you're controlling 60-70% of the market, then small players will not necessarily impact your market share. Even if you increase the prices, your proportion of the market share is going to remain relatively stable. But on the other hand, let's say we have 5% market share held by 20 companies. So if one company starts, burning cash or starts reducing the prices, they might be able to capture the market share of some other companies and, they might go up to 7. So when your market share is very less, it is difficult for, it to go down even more. Why? Because new players will come in and your market share can reduce even more. So on the other hand, if let's say you are having 60-70% market share, it can go 69, it can go 71. But other players relatively have to put in a lot of efforts. They have to have superior technology. They need to burn cash in order to take away your market share, which is relatively difficult. A fluctuating market share suggests aggressive competition where firms avoid raising prices due to fearing the losing of customers. Here, the best example is telecom. If Airtel charges more than MNP, mobile number portability, you will switch to Jio. Jio's market share will increase. Airline, on the other hand, is also a good example. In such industries, companies are more likely to resort to price cuts to gain or defend market share, reducing overall pricing power. Another thing which you have to remember, if you go for price cut, profitability is impacted, but your market share can increase. So if your market share increases and you are able to hold on to it, then in future you can raise the prices and then your profitability goes up. So the point that I was making is, if you go for price cut, your profitability will be impacted, but then you gain a market share, which you may be able to capitalize in the future. If you increase the prices, your profitability may go up in the future. You can write down this point and it will be easy for you to remember. Stable market share, better pricing power, Coca-Cola and Pepsi. So they have brand loyal customers, and there are some customers like me who really don't matter, but it's Coca, Pepsi, whatever is available, we go for it. So their global share remains the same. Even if they increase the prices, their shares are not going to be impacted. Visa and MasterCard are also able to maintain their long-term dominance. Unstable market share, smartphone manufacturers, especially Oppo, Vivo, OnePlus, etc., their market shares tends to fluctuate. And then there are some businesses like Nokia, BlackBerry, etc., and they have completely gone off out of the business. Companies compete through pricing and incentives, because whatever feature Oppo is giving, Vivo will also give, OnePlus will also give, and it is easily copied. So the brand, the advantage, the moat, the competitive advantage is easily eroded away because technology is easy to replicate. The next is ease of exit. Now, ease of exit refers to how easily can you close your business by winding up and selling whatever inventory you have, or finding an alternative use for the product. So let's say I'll give you an example. You have a space, you have a building, and let's say you're running a college over there or any kind of institution. If let's say your admission levels go down, you will be easily able to convert the college into, let's say, a luxury stay, or some kind of a resort, or some kind of a theater, or some kind of a hotel as well. So it is easy for you to switch from one product to other without much difficulty. On the other hand, if you're having an airline business and if you decide to close it, उस plane का तुम alternative use कुछ नहीं कर सकते, because ultimately you will have to sell the plane to somebody else, but somebody else may not buy it because Indigo ka interior or Air India ka interior is very different. So it will be very difficult for you to exit the business. Plus investment recover karna bhi बहुत difficult hai. You would have paid a lot of licensing fee, which obviously might not be refundable. And on the other hand, for airlines, something called as a sunk cost. Sunk cost means cost which you have to incur. So these kind of costs, like an example I'll give you of sunk cost is, you have a plane, and if you are keeping it landed or grounded in any of the airport for a longer time frame, let's say the airport will allow you to land the plane for 2-3 hours, and you have to take off in the next flight. But if you're planning to ground it for like 6-7 hours, you will have to pay some fee to the airport as parking charges. So this is something which airlines want to avoid, and that is why you will obviously see that flights are landing, and then immediately within the next 1-2 hours, flights are taking off either to the same route or some other route. So these are sunk costs, which are very risky. So these kind of costs the company will obviously want to avoid, and that is why you want that is why you find that airlines are constantly filling up their seats because they don't want to incur these kind of charges. Industries with greater ease of exit generally have better pricing power, as inefficient players can leave the market without significant losses. So let's say you start a restaurant and Chalnera, or your food is not good, or the competition is very high. You can easily close your restaurant, sell it to somebody else. He will come, he will take over your kitchen. And then it is very easy for you to exit the business and get back the money which you have invested. Your losses might be limited. When exit barriers are high, for example, specialized assets with no alternative use. That means the airplane, there is no alternative use for it. Firms may continue operating even at low margins. This often leads to price wars, as firm cut prices to cover at least the variable cost, damaging the industry-wide profitability. Again, geo example, if one player dominates the industry, reduce the prices, so it is like you are finishing the profitability of the entire industry. You're reducing the profitability of the entire industry. The Campa Cola mineral water example. So if you're reducing the prices, that means let's say Reliance is earning 1-2 rupees per bottle, and on the other hand, Bisleri was earning 8 to 10 rupees per bottle. So because Reliance is earning very less, it is also eating away the profits of Bisleri. So when companies engage into price wars, they are not only reducing their profitability, they are also reducing the profitability of the industry as well. Real world examples, software services, firm can shut down operations with limited asset write-off. Consultancy firm, the talent can be redeployed easily. You will get jobs. You can easily switch from one firm to other. Difficult to exit airlines because planes would have taken on lease from Boeing or Airbus. The fixed costs to run are very high. You have to pay salaries to the pilots. You have to pay fee to the airports as well. Even in shipbuilding, the assets are customized. They will not have any kind of alternative use. So that is why you want to remain in the business, and even though it is non-profitable. So over here you can write down, if ease of exit is difficult, then you stay in the business even at less profit. If the ease of exit is difficult, you want to stay in the business, you will not want to exit the business, and it is going to eat away your profits. So the basic idea of learning all this is, when you are planning to invest money in a company, you want to avoid these kind of companies where future risk is a ho sakta hai. Why? Because your share price is ultimately tied with your future performance. So अगर future थोड़ा weak लग रहा है, the share price will obviously tumble. Or let's say you have invested your money in a company thinking that it is going to be the next Amazon, or let's say next Google. But you find that abhi iski future potential अच्छी नहीं लग रही है, so you can exit at the right time as well. So let's take a 5-minute break. Then we'll start with PESTEL analysis. If anybody has any questions, or you want to ask something, you can go ahead. Otherwise, we'll start in a couple of minutes. Okay, let's continue. So next we have PESTEL analysis, where P is political, E is economic, S is social, technological, legal, and environmental. Now you can think about Zomato and Swiggy and see how these factors are, can impact our two companies. So P stands for political, which talks about any different rules or regulations the country can come up. So we have FSSAI, which will give the rules regarding food manufacturing and delivery, the safety. So any kind of changes in the regulations, let's say restaurants want to implement a more stricter policy. So costs obviously will go up. Then it's the economical reasons. So let's say fuel prices in the economy goes up. So delivery costs will go up. If delivery costs go up, then your food will come at a higher rate. Then we have the societal changes. So restaurants prepare foods depending on what is there in demand in that particular sector or locality. So let's say in a particular locality, people have become very health conscious. So, they'll be starting eating less junk, and they'll be switching towards more healthy food. So restaurants will have to adjust accordingly. Delivery will also be adjusted accordingly. Then technological, we know that AI is disrupting the industry. So companies that are not adopting AI, they might, face any kind of limitations in the future. They might lose customers as well, or their cost of running operations based only on human efforts will go up. Legal refers to any, legal regulation changes, or any kind of contracts. With Zomato or Swiggy enter into restaurant, if there are loopholes in the legal environment, then restaurants can file a case, or Zomato and Swiggy can file a case. Then there'll be all the recovery process and everything. Environmental, if let's say plastic become completely banned, then restaurants will obviously have to come up with some other packaging material which might increase or reduce the prices of food. So this is how PESTEL must be applied to the particular industry or company to see how it impacts the products. Now, the competitive strategy and position of a company. So an analyst should assess the company's strategy on 3 dimensions. Does the strategy create a defense against the 5 industry forces? Does the strategy benefit or at least not conflict with the PESTEL influences? Or does the company have resources and capabilities to execute the strategy? So let me give you an example. If Zomato and Swiggy, they want to increase, increase their efficiency, and they want to deliver food even faster. So let's say faster delivery, like Domino's promises you in 30 minutes. So if Zomato and Swiggy want to go for faster delivery, they cannot, be a low cost provider. Because if you want to deliver faster, then you will have to pay more to the delivery guys, and the chances of accidents and everything will be higher. The restaurants will take less time to prepare the food. So you cannot be a efficient delivery person, and you cannot cut cost at the same time. So either you can have fast delivery, or you can have low cost, but it is very difficult to have both the things at the same time. If you try to achieve both the things at the same time, you might be stuck in the middle, and you might not be good in either of the two. So that is one of the things. Another example I can give is, if you decide that I want to target premium customers, then obviously you will want to charge a higher price, because in order to capture premium customers, you obviously will not reduce the prices. Because if you reduce the prices, then you are catering to the masses and not the classes. So you will have to adjust your strategy accordingly, and you need to be focused. I want to be the market leader. I want to be the most efficient, product manufacturer, or I want to be the best in after sales service, etc. And you have to prepare your strategies accordingly. So competitive strategy, Porter has identified three chief competitive strategies. The first is cost leadership or low cost strategy. So as I was saying, firm over here seeks to be the lowest price, offer the lowest prices in the industry. A different example I can give you is Zerodha. So when Zerodha started, they offered something known as zero brokerage fee. So before Zerodha came into the picture, Angel Broking, Share Khan, etc., they used to charge relatively high broking fees in order to execute the transaction. But after Zerodha, we have Grow and then we have One Paisa. We have many firms which came into the market and they disrupted the industry. So competition is on the prices and price wars are likely. So over here, firm is competing on the price. It is not competing on the product. Firms may resort to predatory pricing. Predatory pricing means I'm reducing the prices to capture your market share. But they do it only for the short term. Once they have captured enough market, then they start raising the prices. Best example is now you know that the prepaid plans, which was earlier available for 1800 or 2000 rupees annually, now that has relatively gone up. Even internet cost, Geo Fiber is much more expensive than Airtel. To earn profits, mass production and efficiency in cost are extremely critical. So you also need to supply to more people, and plus you also have to reduce the cost. Then differentiation strategy. Best example is Apple and Samsung. So Apple offers you a very different product. So firm tries to distinguish and separate its components from the competitors on parameters like type, quality, delivery mechanism, post-sale service, etc. Now, in the automobile industry, Toyota still rules the market when it comes to safety, service, and efficiency at the same time. We have Maruti, but then Maruti is catering to the classes. We have Tata who manufactures good cars, but it is observed that their after-sales service is usually not good. And then, there are usually some problems in the later years when you start buying, if you don't maintain the automobile. So Toyota still rules the market efficiency in terms of everything. That's why they are able to charge a premium price. To earn profits, differentiation and premium should be very high. That's why Apple products come at a premium price. Focus strategy, where the particular company wants to excel. It refers to targeting a niche market. Executing a focus strategy can include aspects of both cost leadership as well as differentiation. So we have been given a table in which everything is explained. We have, even if something is required, I'll cover only that. Otherwise, all this is pretty obvious. So how can you achieve cost leadership? By going for economies of scale. Economies of scale means once you start producing more, your cost of production comes down. If you have access to cheaper raw materials, if you buy raw materials in bulk, let's say you are a manufacturer and you offer 1000 kg of something or 1 ton of something, you will be saving on the transportation cost, you will be saving on the per unit cost, and you'll be saving on the other ancillary charges as well. You're able to do cost control. If you're able to do cost control, your costs go down and your profits go up. The risk that you face over here is the cost inflation. If the prices of raw material increase, it will impact your profitability if you're not able to increase your selling price. New technology comes into the market, total disruptions, old technology will not work, the products go outdated very fast. BlackBerry went out of business, typewriters went out of business. We had those cameras, digital cameras, roll film based cameras, even those went out of business when digicams came into the picture. You have to defend against which forces? Threat of new entrants like Bisleri, Aquafina. They enjoyed the market for a longer time. New person came into the market and then profitability is impacted. Customer power, as I've said before, if customers can switch from one product to other, they have power and you have less pricing power in that case. Industry rivalry, higher competition, companies will want to engage in price wars. Similarly, we have product differentiation. You can differentiate in terms of quality, features, service. Now, India is a service-oriented market. Wherever people feel that they are getting a better service, they will obviously want to go in that shop. Or let's say you go to a shop, the shop owner was very rude to you. You will obviously not go there again. You will obviously prefer a shop where the owner is very friendly. So those kind of service offerings, difference in service offerings matters, for which people are even ready to pay a premium. Now, one of the best examples that I can give you is robo-advisors. Now, in the finance industry, we have AI who decides, where you should invest your money. But India, people want somebody to talk to, so they will obviously want to have a physical, real financial advisor instead of using machinery as a financial advisor. So that's a very good example for a differentiation. The risk is limitation. People can easily copy. Price pressure will be there. If you keep the prices very high, people may not want to buy your product, and then you will not be able to get some market share. Your revenues will be impacted. If you don't have any kind of copyrights or intellectual safeguarding rights, people can easily copy your technology. Huawei is a very good example. It manufactures a lot of brilliant phones, but then not able to capture that much of a market share in India. Focus, you want to maintain proximity to customers. That means you want to be very customer centric. You understand the customer needs. Banking operates in that way. Mutual funds operates in that way. Uh, Private banks offer relatively better service to their customers compared to government banks. SBI and Axis, if you go to these banks, you will understand how their service levels are different. Larger competitors compete on price. The group loses distinctive features, threat of new entrants, customer power. We have discussed all this. I hope it's relatively easy to understand. So we have some questions. So please go through these questions. Try to guess the answers. I'll give you a couple of minutes to try to guess the answers. Then we'll discuss. So firms and industries are most appropriately classified as cyclical or non-cyclical. So it's basically related to the business cycle and the economy and how the profits or the earnings are impacted. So let's see the options. The stock price fluctuations related to the market? No, because stock prices tend to fluctuate whether you are defensive or cyclical. That's not the answer. Sensitivity of the earnings. This is what we are looking for. The volatility of the earnings related to the competitors. So it's not related to the competitors, it's actually related to the business cycle. So this portion is wrong. So that is why B is our answer. 2 of the 5 competitive forces in the Porter's framework are threat of entry, barriers to exit. So it's not barriers to exit, it's actually ease of exit. We have power of suppliers, threat of substitutes. Yeah, this looks correct. We have rivalry among competitors. Yes. Power of regulators, we don't have this option at all. So here also the answer is B. Which of the following describes a cost leadership strategy? So you are able to manage your input cost. Volume sold can range from modest to high. Volume does not impact cost at all. Managerial incentives to promote operational efficiency. So here I'm saying that I'll give managers some incentive if they are able to, reduce the cost of operations. So yeah, this is potentially a good answer. Success depends heavily on investments in customer service and proprietary distribution channel. So investment in customer service, it's high cost. Proprietary distribution channel, again high cost. So we want something to lower cost. So this is not the answer. So the answer is B. So in CFA, the content is very easy, but when you read the questions, you must eliminate the choices before selecting the final one. So because sometimes the choices will be very closely related to each other, but there will be one small element which will be wrong. So before picking an answer, try to eliminate the other two, because once you are eliminated, then maybe, whatever answer you're left with, that is the right one. So that's a strategy which you can use. Try eliminating if you are not able to get the answers. So next chapter, company analysis and forecasting. So now here we will be requiring some components from financial statement analysis, FSA. So in case if that topic is not covered, I'll tell you the formulas which we need. You can write down the formulas. And then I'll give you some shortcuts also, which will be useful from the exam. So whenever I ask you to write down any note, you can write it down. I will write it on the screen for you to copy it down. These are the learning objectives, learning outcomes. So yeah, forecast objects. So we are trying to do some financial forecasting. That means we are trying to evaluate what will be the future sales, how much will be the future cost, how much will the company spend on capital expenditures, that is buying plant and equipment. What will be the future profitability, whether the cost of raw materials will go up, how much each segment, like Zomato is having Zomato, it is having Blinkit, it is having Hyperpure. So you'll be able to evaluate how much Blinkit's profitability will go up, how much Hyperpure's market share will go up. So we are able to do these kind of forecasting. The 4 key forecast objects include, first is drivers of the financial statements. So these are specific factors like the number of stores or net sales per store that directly influence the financial statements. So here we can take the example of DMart, we can take the example of Lenskart, we can take the example of Reliance Retail. So we can take average sales per store and we can multiply it with the number of stores which are in operations. That will give us the revenue. It is average sales per store multiplied by number of stores. So if a company adds new stores and we assume that the average revenue is going to remain the same, then the sales or the revenue goes up. Then we have individual financial statement lines. So in case no distinct drivers are identifiable, individual financial statement lines are forecasted. So what do we mean by distinct drivers? Now there are some key performance indicators related to a particular industry. So in banking, we have the net interest margin, NIM or NIMS that we call. So net interest margin is a key indicator. In Zomato and Swiggy, we have ARPU, which is average revenue per user. It can also be useful in Netflix. So if we multiply the ARPU with the number of customers or users, we are able to easily identify the revenue. If these variables are not available, like NIMS or it is, let's say ARPU is not available, then we will be forecasting how much by will the sales grow, how much the COGS will grow, how much SG&A will grow, etc. Then we have some key financial indicators like net income and total equity. We will be able to find out how much will the net profit margin increase, how much will be the return on equity, how much will be the return on invested capital, etc. Then we can also do some analysis on ad hoc objects. These encompasses unpredictable events like regulatory changes or lawsuit outcomes that require special forecasting. So let's say we are analyzing Facebook. So Facebook usually comes under scrutiny related to data privacy, etc. So if the regulators fine them for violating data privacy, these kind of things must be forecasted. Another a very simple example, which is relatively applicable to many companies, is if they decide to shut down a particular unit, how much cost will they save, how much sales will be impacted, etc. These kind of analysis is also required. Then we have different kind of forecasting approaches. We can do it from historical trend. So we can take last 10 years data and find out how much is the average increase in sales. We can forecast it for the next 5 years as well. Then we can take a base rate and convergence. So if let's say it's a cyclical industry, that means we'll reach a peak, then we'll come down again. So this trend is followed. So we can identify these kind of seasonal trends or let's say yearly trends in order to find out how much, okay, this particular months, the sales are going to be impacted. Best example which we can use is during summers, companies that are selling air conditioners are able to sell more. So companies like Blue Star, X Samsung, LG, etc. Now LG is also listed, Blue Star is also listed. So you will find that during peak summers, the sales of these companies go up. And if I am forecasting that they will have this much amount of profits and they are delivering more, then obviously it's a good kind of investments. My research is working, or let's say the company has outperformed my expectations. So we can use these kind of historical analysis to identify trends and convergence. Convergence means whatever mean value we have assumed, it will increase and then later of time it will fall down. But on an average, it will be closer towards the mean. Then we can take some management guidance. So companies usually come up with management discussion and analysis in the annual reports. You can read this particular segment MD&A to find out what does the management of the company think about the future of the company. What challenges do they feel they'll face in the coming future? What are the future plans, etc. You can also read something called as con call transcript, CONCALL. That means conference call that happens between the analyst. They will write down all the points. So this is con call transcripts. You can even read over here. You will be able to understand what kind of questions the analysts are asking the management and how the management is giving answers. So these are some of the data points which you can use. These data is easily available on the websites. You can go to the website of a company. Let's say you can go to Zomato. You can get investor presentation reports. You can get these con call transcripts, etc. Discretionary forecasting. That means you are relying on your experience in the industry or experience in a particular sector in order to do forecasting. Then what is the horizon? Usually, let's say some analysts, they prefer to take historical 5-year data and they want to forecast the next 5 years. Some analysts, they take 10-year data and they forecast the next 5 years. So it is totally subjective, dependent on the analyst. And we have to check whether it's a defensive stock or a cyclical stock. If it's a cyclical stock, then a lot of historical data needs to be analyzed to identify the cycle patterns. So a note that you can make over here is, in case of cyclical industry, you need to have more data analysis, more historical data analysis. In our example, food delivery is not a very cyclical kind of a business like automobile. So let's say you can take the last 3-year data and then do a forecast for the next 5 years. On the other hand, automobile, maybe you want to take the trends of the last 10 years to find out whether this industry is going to any kind of business cycle. So the approaches which we can use over here is the top-down analysis. This I've already said, the EIC approach. We can do a bottom-up analysis. That means I'll pick a company, then I'll see how the company is doing, how the management is, what is the future potential of the company, and how will it contribute to the particular industry. So in bottom up, I'm starting with the company, and in top down, I'm starting with the economy. Hybrid approach combines both top down and bottom up to find out, okay, these are some factors I'll take from top down, and these are some of the factors which I'll take from the bottom up analysis. So let's take the example of top down analysis. If I'm analyzing an automobile industry. So if I'm analyzing an automobile industry, I'll probably need to analyze some economic factors. Like let's say, what is the increase in the national income? What is the increase in the per capita income? What are the interest rates prevailing in the economy? So most of the people, they buy automobile on a loan. So if interest rates are very expensive, they might want to postpone their purchase. They might want to wait when interest rates fall. And most of the people in India, they prefer to buy automobile during Diwali and other festival seasons. So when automobile companies give a lot of discounts. So let's say I'm doing my analysis and I have come up with my own mathematical indicator that the sales will grow at 1.5 times the GDP. So if the GDP is growing by 6%, I know that the sales of this particular automobile company will grow by 1.5 multiplied by 6, which is around 9%. So these kind of analysis and variables, the analyst might come up after they have analyzed the particular economy and how the industry is related to the economy. In case of bottom-up analysis, I'm, let's say, doing only the analysis of Zomato and Swiggy. So here, let's say I take the example of number of dark stores and the average revenue per store. So if Zomato, Blinkit and Swiggy Instamart, they establish new dark stores in different cities, I'll be able to analyze, okay, average revenue per store multiplied by increase in number of dark stores, how much will revenue will these different business segments earn. So in bottom-up analysis, it is initiated with an in-depth examination of individual company attributes. Then we analyze the revenue drivers, the average selling price, the volume, the product line, the segment revenue, capacity-based metrics, for example, number of locations like Lenskart, T-Mart, the sales per location, sales per store, etc. We can also use return-based metrics, example, interest income based on loan balances. So this will be utilized by bank. Let's say I'm analyzing a bank. I want to check how much of the loans is divided into automobile loans, how much is educational loans, how much is home loans. Home loans are relatively at a cheaper interest rate compared to personal loans, educational loans, etc. Educational loans have a deferment period and payment usually starts once, let's say, the person is borrowing money, he gets a job. Home loans, may not be dispersed everything entirely at the same time if your property is under construction. So, it will be allotted on a pro rata basis. It will be given to the builder. Let's say you're taking a loan of 1 CR, 10 lakhs will be dispersed this year. Next year, 30 lakhs will be dispersed and so on. In a hybrid approach, let's say we can take how inflation is going to impact the average order per user for Netflix or for Zomato and how it is going to impact the profitability of the business. Then we have to distinguish between recurring and non-recurring items. So we do forecasting only of recurring items. Something is non-recurring or something is very rare, we usually do not include it in our forecast. For example, loss by fire or loss due to natural calamities or an event situation like COVID. Now it's very rare that another COVID might not happen that soon. So these kind of things which are non-recurring in nature, it is very difficult to forecast, and we must set aside these kind of things. A good example from financial modeling is we do not do forecasting of deferred tax because we don't know what will be the deferred tax amount. We don't know what will be the loss in case of foreign exchange conversion or in case of any revaluation of plant and machinery or let's say impairment of good. So these kind of expenses that we see in the income statement, we will not be able to using it. Will not be using it for forecasting because it will be very difficult. So non-recurring items should not be included in the forecast. So you can just make a note of this. Non-recurring items not included in forecast. Analyze only on a standalone basis. Is saal ho gaya? What is the probability of it occurring next year? The probability of this occurring next year is high. Then only you will use it in forecasting. Otherwise, not. Non-recurring items includes those disclosed by company management and other items that analyst believes a forecast should encompass. Analysts must be prepared to quantify both types. So is it non-recurring, but it can happen in the future? or is it non-recurring and it may not happen in the future? You have to adjust your analysis accordingly. Management disclosed non-recurring items. This you will usually find it from the annual report data. Typically focuses on one-time events, for example, a large special order or any kind of foreign exchange gains you have experienced because of foreign exchange fluctuations. This do not constitute sustainable or ongoing revenue. So this is important. If you are earning profits, these profits are not sustainable because it will not happen frequently. It is often removed from regular revenues and disclosed separately, helping analysts determine that this revenue is mostly likely to recur or will not. If a company cites non-recurring items regularly, an analyst might expect this trend to continue and incorporate them into forecast. So let's say accidents. Now, Zomato and Swiggy, we'll take a very relatable example. So if a lot of delivery partners are meeting with accidents, and Zomato has to spend a lot on their healthcare cost. So these kind of things must be included in the analysis. Let's say there's a manufacturing plant and it is frequently catching fire, or it is frequently shutting down because of labor strikes, etc. Then those things must also be incorporated in our model. Non-quantified recurring items, analyst identified. So this is something manager is not saying. This is you are analyzing it on your own. It requires analyst insight and judgment. Example, during COVID, some analysts expected a permanent shift towards online retail stays. So COVID may people assume that now everything will happen online. Retail stores, people will not go there in order to buy clothes. Everything shopping will be happening online. Another very relatable example is from the education industry. Many people believe that now online education will pick up, but over the last couple of years, people have started again switching back to classroom-based learning, because that is where you get to interact with different people and the teachers as well. So 18 months later, online sales began returning to pre-pandemic levels, showing that analysts who treated the shift as non-recurring were correct. So if you assume that, okay, now everything will happen online and you are valuing e-commerce business more than physical stores, you would have gone wrong over there. So this is not something the management has stated. This is you have analyzed on your own. So when choosing among the forecast approaches, analysts must account for risk factors such as competition, business cycle changes, inflation, deflation, technological changes, etc. So inflation or deflation is one of the key things, because it impacts your revenue. It also impacts all your costs. So this is something which you must definitely take into account. Technological changes, if there is a sudden shift in the industry, let's say AI is coming into the picture. If a business is not investing much in research and development of the AI, then they might be losing sales. Another relatable example is EV. Now people have started buying EV related vehicles. So if you find that any of the automobile companies not investing in research and development in EV, or plant that is helpful in manufacturing the EV OEMs, then it will be difficult for this company to face the competition. Not all risk factors may be significant for a given company or industry, but an analyst must determine which ones are significant and which we must helpful in the forecast. Scenario analysis is a useful approach to forecast the effects of these kind of risks. So whenever we are preparing a financial model, we usually take a base case scenario, we take the best case scenario, and we take the worst case scenario. So this is scenario analysis. In base case, let's say we are assuming that it will be 10% growing every year and market share is remaining stable. Best case scenario, we are assuming that it will be growing by 15%, market share will also increase by 10%. In the worst case situation, we are assuming that we are going to experience a negative and our market share is also going to go down. So financial modeling, sensitivity analysis is very important. Base case situation, best case situation, and worst case situation is what we show to our investors, so that we are able to give them a range that I'm expecting the net profits to be between 10% and 15%. If in case a loss happens, this is the loss that I'm expecting as well. So that is why they also have share price. The share price can fluctuate in this particular range. So here's an example. Assume a company's COGS as a percentage of sales equals 25% and the output volume is stable. If input costs double and this is fully passed on to the customers, calculate the impact on profit margin. So they have given you some historical data. Sales are 100. COGS is 25%. So this is 25. So 100 minus 25 gives us a gross profit of 75%. GP margin, the formula is GP divided by sales. So this company is having a gross profit margin of 75%. They are saying that input costs have become double. That means 25 has become 50. And this is fully passed on to the customers. So that means 100 will become 120. So this will give us again 75. Gross profit is going to be 75 divided by 125 multiplied by 100. And this is 60%. So over here what we see is the gross profit of the company has gone down. When we do analysis, why has it gone down? It has gone down because the input prices have increased. Though we are able to pass on the increase in price to our customers, but it is not enough. If company has to maintain the 75% profit margin, so over here, if my cost is 1, then I'm charging my customer 4. So this is the kind of ratio. If you maintain this kind of ratio, then my profit margins will be stable. Otherwise, it is going to reduce. So how can we forecast operating expenses? COGS is tightly linked to sales and it is generally estimated as a percentage of revenue. So COGS is equal to some percentage, let's say X percentage of revenue. So in the previous example, it was given as 25%. There are two methods for forecasting COGS. We can forecast COGS, how much was the historical COGS divided by revenue, multiplied by estimate of future revenue. Or we can do 1 minus gross margin multiplied by estimated revenue of the future. So you have to remember the formula. Sales minus COGS will give you gross profit. So let's say if sales are 100 and I'll tell you that the gross profit is 25%. We obviously know that this is going to be the missing one. If I'm assuming that my sales are going to increase 150, my gross profit margin is going to remain at 25%. You have to find out how much is the COGS. So over here, what we'll be able to do is we'll take 25 divided by 100 multiplied by 150. We'll get the answer. This is my gross profit. I'll reduce it from my sales and that will be my COGS. So let's solve this. My gross profit over here is 37.5. My COGS is going to be 180. So if we keep an assumption that the gross profit is remaining constant at 25%, and if we increase the sales, we forecast that the sales are going to be 150%. We'll be able to use this ratio to find out the missing value, which is our COGS. Now, you will be learning about a lot of financial modeling in the separate CFA course, which is there on financial modeling. Over here, they have explained you the theory, but it is better to learn this in the practical form as well. Next, we forecast selling, general and administrative. Again, this can be considered as a percentage of sales and we can forecast accordingly. So let's say SG and A expenses are 10% of sales. So how much ever revenue you forecast, 10% of that, it is going to be used in SG&A. And this will help you determine how much is the operating profit, which is EBIT. So SG&A comprises of fixed and variable components. It exhibits different sensitivities to changes in sales trend. Fixed elements can be projected using the fixed growth rate plus inflation. Variable elements have a more direct correlation with the sales volume. So let's take rent. So rent is an example of a fixed element because rent is not going to fluctuate with your sales. Rent is going to remain fairly stable. But with the passing of every year, your rent expenses goes up at a particular rate, let's say 10%. So we know that rent has to be increased by 10%. On the other hand, power. Power is a variable expense. So the more power you use, the more you operate your machinery, the power expenses are going to go up. The more employees you employ, the employee salaries is going to go up. Plus people who have already worked for you, they will demand more next year. So employee costs are somewhat flexible. Rent is something which is fixed in nature. Then we forecast how much is the working capital requirement. So we'll do an example later on. So over here, we are going to forecast the accounts receivable, the inventories, and we are also going to do the forecast of accounts payable. So accounts receivable, many of you will know this as debtors. This is creditors, and this is inventory that we show in the balance sheet. So we are going to use ratio. If you know about the turnover ratios, we are going to use it over here in order to forecast how much will be the accounts receivable, the inventory, and the accounts payable. So before we start this question, it will be better that we write down some formulas which will be useful. So we will write down formulas for days sale outstanding, days payable outstanding, days inventory in hand. We will write down three formulas: days sale outstanding, days inventory in hand, and days payable outstanding. So this is average receivable divided by sales multiplied by 360, 365. You can take both. Days payable outstanding is average payables divided by payables amount if available. Otherwise, we can take COGS multiply by 365. Days inventory in hand. The formula we use is average inventory. And again, in the denominator, we have COGS multiplied by 365. Let's reduce that. So it is better to write down these formulas in case if you don't remember, because it will be useful in the next slide. We also have debtors turnover ratio. So this is sales upon debtors, which is receivables. We have payables turnover ratio, which is COGS divided by payables. We have inventory turnover ratio, which is inventory divided by COGS divided by inventory. Now you will learn, or you would have learned all this. Days sale outstanding basically tells you if I've sold my goods on credit to my customers, in how many days they are paying me back. So let's say if the answer for this is coming as 30 days, that means if I'm selling goods to my customers, they will repay me back. They'll pay me in cash after 30 days. Payable outstanding, if I'm buying raw materials on credit, in how many days do I have to make the payment? So let's say this is coming as 45 days. So that means I have to make payment to my suppliers in 45 days. Days inventory in hand tells you if I'm buying an inventory, let's say I'm a retail store, I'm buying an inventory, for how many days do I have to store it before I'm able to sell it? So let's say this is coming as 20 days. So that means when I'm buying an inventory, it will be sold or it will be converted into sales within 20 days. Then we have the turnover ratio. Turnover ratio tells you how many times in a year do I collect money from my customers? How many times in a year do I pay money to my suppliers? And how many times in a year am I able to sell my inventory in a year? So these are some of the ratios from financial statement analysis that will be useful for us in the next question. So make a note of this and then we'll go ahead to solve the question. I'll give you a couple of minutes. So we have to forecast the working capital requirement over here. We have been given the current year data, CNY is Chinese yuan. We have a revenue, we have COGS, we have accounts receivable, we have inventory, and we have accounts payable. The analyst forecast revenue growth of 18%, 16%, and 13%, and gross margins of 17, 17, and 16 for the next 3 years. Okay, so my revenue right now is 245,866. It is going to grow by 18% next year, 16% the year after that, and 13% in year 3. So I can directly multiply this by 1.18, then 1.16, and then multiply by 1.13. What I'm doing is I'm multiplying it with 1 plus R. So we will have an answer for this one. And then whatever answer we get, my third year gross profit margin is going to be 16% of that. So let's see what the answer for this is. So this is 380. 290. So this is going to be my revenue for year 3. So this is my 3-year ahead forecast of sales. Now it is asking me for COGS. If 16% is my gross profit, then 84% will be my COGS. So iska multiply by 0.84 will give you the answer for COGS.
So just one quick one. Yeah, I think screen share is.
Okay, so as I was saying, if 16% is my gross profit, my COGS is going to be 84%. So let's see what is the calculation. So my sales multiplied by COGS, this answer will be 319,445. This will be my COGS. So I've got the answer for forecast sales. I've got the answer for my COGS. Now it is asking me to calculate DSO, DOH, which is DIH, and DPO is days payable outstanding. So let's calculate DSO first. DSO is going to be accounts receivable 10161 divided by, I have given you the formula, divide by revenue 245,866 multiply by, let's say, 365. So the answer is coming as 15.1 days. This is my DSO. So that means my customers are paying me money every 15 days. Then we have DIH or DOH. This is going to be inventory divided by COGS 209,114 multiplied by 365. The answer for this is 72.7 or roughly 73 days. So that means when I'm buying inventory, I'm holding it for 73 days, then I'm able to sell it. Then we have days payable outstanding. You have got the formula payables divided by COGS. So DPO. The answer for this is coming as 126 days. That means I have to pay money to my suppliers every 126 days. We'll also be able to calculate debtors turnover ratio, inventory turnover ratio, and payables turnover ratio. So debtors turnover ratio, it is going to be revenue 245,866 divided by receivables 10161. Inventory turnover ratio is going to be COGS 209114 divided by inventory is 41671. Payables turnover ratio is again COGS 209114 divided by payables is 72199. Receivable turnover ratio is around 24. Inventory turnover ratio is around 5. The unit of measurement is times. Here also it is times. And payables turnover ratio is around 3 times. It is around 2.8. I have rounded down. So we have the historical data. We have historical DSO. We have historical DIH, DPO. And we have debtors turnover ratio, inventory turnover ratio, and payables turnover ratio. Now what we have to do is, so let's say debtors turnover ratio. We know that debtors turnover ratio, the answer is 24 times. Okay. What we'll do is, instead of taking historical sales, we will take our forecast sales. My forecast sales is coming as 380,292. So over here, I'll write 380,292. 380,292. This is what I have to find out, X, and the answer is around 24. So in order to solve for X, I'll do 380,292 divided by 24, and this will give me my answer to X, and that X is going to be my accounts receivable. Similarly over here, my inventory turnover ratio is 5 times, and my COGS, new COGS is 319,445. So if I do 319,445 divided by 5, I'll get the answer for my inventory. And if I do 319,445 divided by 3 times, I'll get my answer for payables. So using this data, I'm able to find out what will be my 3-year ahead forecast receivables, inventory, and okay. So I hope this is clear. If you have any doubts or questions, you can post it in the chat screen. Again, for inventory turnover ratio, we know that the answer is 5. If we do new COGS divided by 5, you will get the answer for new inventory. If you do this and if you divide it by 3, you will get the answer for payables as well. What will be your new payables? So this is how you are able to forecast the working capital requirement of the company. So you have answers in the slides, which you can check. Moving on, this is the theory which we have just discussed, how to calculate day sale outstanding. I have given you all the formulas, you have written it down. It's also there in the slide. Day sale outstanding, it's accounts receivable divided by revenue, and then you multiply it with 365. You're also able to get day sale outstanding and the inventory turnover ratio. From that, you are able to find out accounts receivable. So you can use the formulas which I have shared on the screen in order to calculate DSO, DOH, and DPO. Now, moving on, we will also be able to forecast how much money is invested in CAPEX, which is property, plant, and equipment, and how much money we need to raise in the form of debt and equity. So if you want to expand, you want to invest your money in property, plant, and equipment, from where will you make the investment? Either you will borrow money by issuing bonds, or you will take a bank loan, or you will come up with a new equity issue, which is either a follow-on public offer, or you will dilute your stake, or you will come up with an IPO. So forecasting capital investment, you utilize the cash flow statement for additions and disposals and the income statement for depreciation. So the data over here is going to come from cash flow statement and it is going to come from income statement. In our cash flow statement, we will be seeing the cash flow from investing activity, and income statement, you will get the current year depreciation. Historical depreciation is adjusted by the relevant inflation rate due to increase in replacement costs. Now, why do we charge depreciation? So let's say you're buying a car for 10 lakh rupees and every year you are charging a depreciation of 1 lakh. That means it's like a reserve or a provision. You are setting aside 1 lakh rupee every year for the next 10 years so that once you sell off this old car, after 10 years, you can buy a new one. And from your reserve, you will have again 10 lakh rupees. but you're not accounting for inflation. आज जो गाड़ी 10 lakhs में मिल रही है, आगे जाके you will not get the same car at 10 lakhs. Maybe the cost would have gone up, or maybe you would want a new model. So we will have to increase the depreciation by inflation in order to account for future purchases. Then, in order to calculate, let's say I want to raise $100 million. Where will I raise this $100 million? How much debt will I raise? How much equity will I utilize? Or if I am having reserves and surplus, I can even take my money from my reserves. So it requires analysis of leverage ratio, target capital structure, and borrowing. So let's say there's a company, the company wants to maintain 70-30 ratio, 70 equity and 30 debt. That means if I am raising 100 million, 70 will come from equity or from reserves and surplus, and 30 will come from debt. So this target capital structure, we will come from the management understanding from the annual report or from the discussion with the management. We are also determining the value of future asset purchases, and it is subjective. It relies on understanding of management growth and strategy. Now, not necessarily every year the company will invest money in property, plant and equipment. It will make heavy investments or new investments only when it has planning to grow. Otherwise, they incur only normal routine capital expenditure, which is to maintain the production capacity of their plant or equipment. So we have an example to calculate the asset requirement as well. So over here, they are saying that the capital expenditure on property, plant and equipment relative to the revenue remains at year 3 level. So we have to find out how much is the revenue of year 3 and how much is the capex of year 3. The same will be utilized in year 4 as well. Then they are saying that the capital expenditure on intangibles will be as per revenue that was there in year 1, and then intangible investments that was there in year 1 as well. So on PP&E, they are saying that the investment in PP&E in year 4 will be very similar to year 3. Investment in intangibles will be very similar to what was there in year 1. Goodwill, they are keeping it at the same level of year 3. Depreciation amortization to remain at year 3 level relative to the opening asset net balance. Okay, so here they are giving us a formula. So depreciation is calculated remain at year 3 level relative to the opening net asset balance. Okay, I'll show you what is to be done when we reach the sum. And then they have given us a revenue forecast of 290,112. So let's see the data. So new revenue, year 4. The revenue I'm estimating is how much? 290,112. So 290,112. This is what they have given me. And then they have given me certain conditions. I'll read condition number 1. The capex on property, plant and equipment relative to revenue at year 3 level. So the capex for the year 4 is going to be very similar to what they have done in year 3. Okay. So year 3, my revenue was 245,866. So how much is the capex of year 3? So my year 3 revenue was 245,866. And the capex investment that I had made during this particular year was 3026. So this ratio is telling us capex, that means the new investment in property, plant and equipment, what we had done in year 3, we have to calculate the percentage of it from the revenue. The same percentage is going to be applicable over here. So the answer for this is coming as 1.23%. This 1.23%. So what they are saying is this year the capex is going to be 1.23% of 290,112. So let's see what is the answer. It is going to be 3571. 1.23% multiplied by the new revenue, and it is going to be 3571. Next, the condition they have given is capex on intangible will be very similar to revenue at year 1 level. So now how much are we investing in intangibles? So this is similar to year 1. So in year 1, intangibles we had invested 333. Revenue that year was 174,915. So we have to take 333 divided by 174,915. The answer for this will be close to 0.19%. So in year 4, your investment in intangibles is going to be 0.19% of 290,112. This is going to be 550. So we have calculated two variables which we need. Let's see next. Goodwill is to remain at year 3 level. So no change in goodwill. We don't have to do any adjustment for that. Depreciation at year 3 level relative to the opening net asset balance. That is depreciation relative to net PP&E and amortization relative to opening intangibles. Okay. So depreciation at year 3 level relative to opening net asset balance. So we need opening net asset balance of year 3. Opening net asset balance of year 3 will be closing of year 2. So you can write this note. Opening net balance of PP&E for year 3 is equal to closing net PPE of year 2. Okay, so my denominator is 6992. The depreciation that I have charged in my year 3 is 518. We need to take a ratio 518 divided by 6692. Let me read the condition again. Yeah. So depreciation at year 3 relative to the opening net asset balance. That is depreciation relative to net PP&E and amortization related to opening intangibles. I think there's some wording error which we will correct. So this percentage is coming as 7.41%. We have to charge depreciation at 7.41%. So okay, it will be charged at the opening balance. Year 4 opening balance is the closing balance for year 3. So 7.14% multiplied by 6306 will give us depreciation for this year. So the answer for this is 467. 467. This is depreciation. So for year 4, what we have to do is we have got the percentage over here. We have to charge 7.141 percentage of the opening balance. Opening balance for year 4 is going to be closing balance for year 3. So we are going to take 7.41% of 6306. We will have the depreciation for this year. Now similarly, we have to do it for intangible amortization as well. So let's read the condition, what is mentioned. So for amortization also, we have to do the same thing. Amortization is 666. Opening balance of intangibles will be the closing balance for year. So it is 666 divided by 14. This is around 47%. So 46.7%. Intangibles is 3310 of this particular year. The closing intangibles is 4013. So we have to take 4013 multiplied by 46.7%, and let's see what is the answer for this. That is coming as 18. Now slightly it's difficult because I have to switch between two slides to see the question and the answer. So intangible amortization, again we have got the rate. The rate is charged on the opening balance. Opening balance for year 4 will be closing balance for year 3. So closing balance for year 3 was 401. So we will charge 47% of this. So let's see what next adjustment we have. So that's it. I think we have completed the question. This is what they have asked. We have calculated how much is the capex. We have got the answer. We have calculated how much is the capex for intangibles PP&E. We have calculated depreciation, and we have also calculated amortization. This is the closing balance for year 3. So this becomes the opening balance for year 4. So this is the opening. This is the addition that we have made in PP&E. This is the addition that we have made in intangibles. This is the depreciation, and this is the amortization. We take a total of this. This was our sales. I'll remove this. If we take a total of this, this is my closing balance for my property, plant, and equipment. So the total of this is coming as 12,300. So it was slightly complex. I had to switch between slides, but I hope the calculations are clear. You can rewatch again the video in order to understand this. The only thing that you have to remember is we are doing a lot of calculations based on the opening and closing balance. What figures are mentioned over here, these are the closing balances. What is the closing balance for 1 year becomes the opening balance for the next year. So like over here, this is the total fixed assets. This is the closing balance for year 3. So that becomes the opening balance for year 4. Then we adjust all the additions made during the year. If you have sold anything, we will reduce. And then we are also going to reduce the depreciation. Now in this question, they are asking us how much we have to predict. So let's say assume year 6 target EBITDA margin is 6%, gross debt by EBITDA ratio of 1.25, 1.5, and 2. It was for year 4, 5, and 6. Year 6 predicted revenue is 380 to 92. We have to calculate expected gross debt. Okay. So gross debt is calculated using this ratio, gross debt by EBITDA. For year 6, the ratio is going to be 2. Okay. So they are saying gross debt divided by EBITDA for year 6 is going to be 2. This is a question mark. If we calculate EBITDA, we will multiply it by 2 and we will get the answer. To calculate EBITDA for year 6 is not given, but we have been given EBITDA margin. So 6% multiplied by sales, this gives you your EBI TD. So it is 0.06 multiplied by, we have been given year 6 predicted revenue 380. So 380 to 92. We solve for this, we will get the EBITDA. The answer is 22,818. 22,818. So 2 multiplied by 22,818 will give you the gross debt, which is 45,635. So they have asked us to calculate gross debt. They have also given us which ratio we have to use. We have to use gross debt by EBITDA. They are saying that this ratio for year 6 is going to be 2. So gross debt by EBITDA, this ratio is going to be 2. We have been asked to find gross debt. If we have EBITDA as the answer, we just have to multiply it with 2 and we'll get the gross debt. To calculate EBITDA, they are telling us that the EBITDA margin is 6% of revenue. They have given us the predicted revenue. So 6% multiplied by sales is going to be a EBITDA, 6% multiplied by expected sales. This is coming as 22,818. We just multiply it with 2 and we have the answer for the gross debt. So this was a relatively simple question. So the next is scenario analysis. Forecast should not depend on a single number. Like I've explained you before, when we are doing scenario analysis, we take the base case scenario, we take the best case scenario, and we also take the worst case scenario. So analysts should create multiple scenarios with different assumptions. It helps us to identify how one key factors change. Assumptions may be based on economic conditions, competitive environment, and technological changes. So let's say I'm trying to find the impact on net income. How much will my net income be impacted if inflation is changing by a particular rate? If my cost of raw material increases by X percentage, if my number of customers go up by 5%, if my average revenue per user, it goes up by, let's say, another 10%. So how multiple factors is going to impact my net income. So when I'm preparing my financial model, I change all these rates. Okay, as per the situation, we have a best case, base case, and worst case situation. And then we'll try to find out how much it will be impacting my net income. So it's easier to do this in Excel. It will be relatively difficult to explain this in theory. So this is scenario analysis. We are taking multiple situations. We are going to take base case, best case, and worst case situation. And we'll find out how much this impacts my net income. So here's a question. I'll give you a couple of minutes to think for the answer. So which approach is most appropriate for an analyst to use forecast revenues for a company in a highly cyclical industry? So if it is cyclical industry, we cannot use historical results because historical results, let's say last year, if last year we had a peak, so this time maybe we'll have a recession. So last year's data cannot be used to forecast this data. So historical results will not be useful. Analyst has to use discretionary. The answer is yes. Historical base rate and convergence. Again, if it is cyclical, then things may not converge. Things will be pretty volatile. So over here, analyst has to use discretion. So the answer is B. Which of the following items is an example of a summary measure? So revenue is not a summary. It's a single value. Free cash flow. If you have heard about the term free cash flow to the firm, free cash flow to equity. So this is a summary measure because it's a formula and the formula gives you an answer. So free cash flow is the answer. Contingent liability again is a single item and it is not a summary. So the answer is B over here as well. So question number 3. An analyst is performing scenario analysis for a company's gross margin. Selected financial data from the current period is provided here. So average selling price is 10. Quantity sold is 4.5 million. Gross margin is 60%. Okay, gross margin is 60% means COGS is 40%. For a next period, the input prices are expected to increase by 15%. Okay, and the analyst expects the company to increase the selling prices by 12%, resulting in a 10% decrease in the volume sold. We have to forecast decrease in the profit margins for the company's next period. Okay, so over here, I will suggest you one thing. Instead of taking quantity sold as 4.5 million, because in exam you have to save maximum time, let's take it as 100. Okay, so the answer will not vary much because we are just fluctuating the quantity sold. So let's see. We are saying that the input price is. So let's write my selling price is 4. Selling price is 10. Quantity I'm going to use is 100. My cost price is 4 and my GP margin is 6. So what we are saying is input prices are expected to increase by 15%. So this is going to be 4 multiplied by 1.15. Selling prices are increasing by 12%. So it is going to be 10 multiplied by 1.12. And my volumes are decreasing by 10%. So instead of taking 100, I will have to take 90. Let's calculate the impact. So my gross profit over here was 600. Let's see what it is over here. This is 1008. This is 414, 594. So 600 has become 594. That means it has reduced by 1%. The forecast decrease in gross profit margin is 1%. So you need not take 4.5 million because your sums solving will take time. So best is take 100 because it is easy to make the adjustment. So 600 has become 594. It has reduced by 6. 6 is 1% of 600. So we are expecting the input prices. We are expecting the gross profit margin to decrease by 1%. So we are done with session 4.